This will change everything. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Morgan Stanley's grim prophecy sends shivers through the banks and Wall Street. And you're not going to believe what Morgan Stanley says the next problem for banks are and why this one could be the one that sends them under. Plus, we're starting to see panic out of Beijing as further evidence that their proper developers are on the verge of an outright collapse. And if you're wondering what we're doing at the ECB today, well, I want to show you just how desperate central bankers are getting. Now let's head over to Bloomberg, where we picked today's story up with a headline. China asked Ping An to rescue Country Garden. This according to Reuters. The insurer says, well, wait a minute, this report is completely untrue and no requests were made. Now I want you to understand here, why would Ping An deny this report? Let's go on the basis that there's some evidence that it's true, because if you think about it, Beijing does not want any public record that they are bailing out a privately held company. It sets bad precedents. It tells us that the property developers are even in worse shape than we already believe they are. So they turn to a private insurer and said, hey, look, can you bail them out? And of course, you think about it from Ping An's perspective. They don't want to be on record as saying that they're coming in to rescue Country Garden, because if any of this is true, it will send shockwaves through the Chinese financial system and the rest of the world. Let's take a look at this a little deeper, because China's State Council has instructed the local government of southern Guangdong province, where both companies are based, to help arrange a rescue. This suggesting the Country Garden's in far worse shape than we already believe it is. Ping An said in a statement that the report is untrue and it hasn't received any such request from any relevant government agencies. Of course, Country Garden didn't respond either, probably because they're too busy dealing with their insolvency. The issue here is the fact that there's even talk of bailouts, telling us that China's property developers are in dire shape. There's no bailout from the private industry, means the government's going to have to step in, because we're talking about the banks today, and this is critical. The banks hold so much of this debt. If these property developers fail, you know that the Chinese banking system collapses. And we've seen what happened during the global financial crisis, how quickly things can spread through the global financial system. And China, the last thing they want to be on record for is starting the next global financial crisis. Authorities want to avoid the risk that Country Garden's liquidity problems, see, here we go, spill over to the wider economy. And sure enough, it would spread not just to the Chinese economy, but all over the world. The talks with Ping An started in late August and remain at an early stage, it said. And here's further evidence this liquidity problem is only getting worse as China's central bank vows liquidity for debt-laden regions. So here again, we think about, why does anybody need liquidity? Because when the global economy slows, when central bankers invert yield curves and money curves, which cause banks to tighten lending standards and constrict the creation of credit, you now have a problem. In a debt-based economy, the priority is paying on the debt, which means you first sacrifice growth, and then you start having a problem of people being able to pay on the debt. But if you have enough growth, the debt isn't an issue. Now all of a sudden, there just isn't enough growth and not enough money for all the debt. When it's necessary, the People's Bank of China will provide emergency liquidity support to the regions with relatively heavy debt burden. This comes from Pan. He's a central banker there in China, as financial regulators have worked with other authorities to resolve debt risks at the local level this year. He added that government debt levels are at a mid to low level compared to other nations. So, of course, you have nothing to worry about. And yet, here he is on record saying, we're going to provide emergency liquidity if necessary, which tells us that maybe publicly they're saying that their debt levels are at a reasonable level, but perhaps behind closed doors, they're in far worse shape. And it could be from the other perspective. Maybe the Chinese economy has taken such a deep downturn internally that we can't see it, and that perhaps there just isn't enough money to pay on all this debt. As China's been attempting to diffuse risk from its large pile of off-balance sheet local government debt, there you have it, without resorting to major bailouts. That's a difficult task for President Xi Jinping's government, because it faces a fragile economic recovery hindered by a property slowdown. And this is exactly what happens when central bankers blow major credit bubbles by suppressing interest rates. And in this case, on top of it, we had massive amounts of pandemic stimulus all over the world. You You have these huge inflated bubbles. You try to shrink them. The problem is you can't. At some point, the bubble pops and everything comes collapsing down. There's no way to avoid this at all. Pan also vowed to satisfy the financing need of all types of developers, regardless of whether they're private or state-owned. So here you can see, not only is he coming and saying, look, we're going to provide liquidity to these various government entities, and we're also going to provide functionally unlimited liquidity to the property developers. It's telling us that things in China are much, much worse than we believe. The spillover impact on the financial system from the real estate market's correction is generally manageable, he said. This sounds like something perhaps Janet Yellen might have said back in the global financial crisis, or even Ben Bernanke, until it became an all-out crisis. It's always manageable until it's not. But now let's head over to the ECB, because I want you to see just how desperate central banks are getting. As the ECB says, consumer inflation expectations increased in September. But get this, let me show you where they're being increased from, because this is the real story. Consumer expectations for Eurozone inflation over the next year rose noticeably in September, highlighting why European Central Bank plans to keep interest rates elevated for an extended period. And so there's a basis of this, that consumers think inflation is going to stay elevated, even though we know it's not, and it will provide plenty of evidence to show you that. The reality is central bankers need any excuse to keep rates up, because that's what their mantra is right now: higher for longer, maybe even higher, but we got to keep rates up. So look at this. The poll was conducted after a summer during which inflation held above 5% in the 20-nation Eurozone. It's since plunged, but of course central bankers don't care about that. They only care about the report, with consumer prices rising just by 2.9% from a year ago in October, down from a peak of more than 10%, and within sight of their ECB's 2% goal, which just adds further evidence that the U.S. Consumer Price Index is also headed lower at the time when many consumers say it's headed higher. But let's talk about inflation expectations, because really it's all about gasoline prices. Here we're looking at the University of Michigan. This is inflation expectation data. This is from Blue. This is based on surveys of consumers. And as you see, we have overlaid the U.S. regular all formations gas price at in red on a year-over-year rate of change. And we can note that gas prices from this time last year are actually down a little bit. And of course, when consumers see that, that means their expectations for inflation are headed down. The problem for the ECB here is they want to make the case that inflation is headed higher, and they need it. So they're going back to look at a report that isn't actually telling us what's going on today. But what's happening right now is we set up what's going on with the banks and why Morgan Stanley has such a grim prophecy. We got to set this up and take a look at what's going on first in the mortgage market. As U.S. 30-year mortgage rate tumbles by the most in more than a year, as contract rate dropped 25 basis points and mortgage applications rose significantly, of course, we start to think about what's going on here, and the evidence that we keep hearing is rates have to go higher, and yet rates are falling. But one thing that should be rising is your trading account, because if you understand that rates are going down, well, you don't have to. Our reports told you. They're headed lower. And here you can see from our Momentum Timer Pro report going back to November 2nd. Let's give you an update on this trade we featured on the show. Here you can see TLT. This is our technical analysis report. Takes all those things like the MACD and the Stotch and the RSI and smooths all those out and gives you one easy report. And on November 2nd, we had a one daily count, a technical signal telling us a buy signal occurred, and now you pair that up with our CTA Timer Pro report. This is our machine positioning. This takes a look at what's going on with the machines. We came off extreme positions on TLT, and we saw a bunch of buying from a short covering position. Now you may remember, our report tends to lead what the actual machines do that we talk about on Sunday, giving you the advantage here. But notably, on November 2nd, both of our reports said you should buy. This is what our most successful traders using our reports do. And here you can see the evidence. You would have bought on this green candlestick at market open. Had you done that at the time of recording, you'd be up 2.85%. At a time you know the machines are following much more behind this as price rallies. They're going to buy, giving you much more upside potential. One trade pays for both reports for a year. And today I put out 5 coupons for each for a free month. Grab them before they're gone. Links in the description below. Now let's take a look what's going on in the mortgage market as we set up the issue for banks here. Because looking ahead, we think they've now seen the peak in mortgage rates and anticipate a steady decline over the next 2 years. I'm going to make the case why rates are going to come down much, much quicker than that. But nevertheless, even so, we don't expect them to fall below 6% before the end of 2025. They're going to be probably close to 2% by that point, far higher than the 4.1% average of the 2010s. That will keep affordability stretched and dampen any potential of a major recovery in housing activity. No, it is really going to have a problem with housing activity is not interest rates. It's the fact that interest rates are going to crashing down. The issue is going to be we're going to be in a recession and a financial crisis. There's going to be no demand for housing at all because there's going to be too many people out of work. And yet the MBA's overall index of applications, which includes purchasing and refinancing, rose 2.5% last week from the lowest level since 1995. Refinancing also edged up. Now, why does this matter here? It's because how do banks make money when they originate new loans? They have originations fees. They make money off the spread of the interest rate. So this is critical. We're seeing still very low demand from the housing market. So I want to set this up because now let's take a look at what Jay Powell had to say. As Powell urges Fed economists to be flexible on forecast methods, he doesn't comment on outlook for interest rates because he doesn't want to at this point. He knows that global economy is slowing down. He knows he went too far, but he's got to act tough. He's got to act confident, and he's got to pass the buck to someone else. And Federal Reserve Chair Jerome Powell said the central bank must be willing to think beyond the complex mathematical simulations it traditionally uses to forecast the economy. Now, I want you to understand, this is what they want you to believe they do. They want you to think they've got some big supercomputers at the Federal Reserve, and they've got all these PhD economists running formulas, crunching numbers, and it spits out and tells them that, hey, this is what you should do with the federal funds rate. And none of that is true at all. They have meetings, they make ad hoc decisions on this. It has nothing to do with anything about a mathematical simulation. And yet intellectual rigor has to be combined with flexibility and agility, the Fed chief said. Even with state-of-the-art models, we certainly can't get any of our predictions right. And we're historically wrong 100% of the time, but yet they keep trying. And even in relatively calm times, the economy frequently surprises us, telling us our models are wrong. But our economy is flexible and dynamic, and subject at times to unpredictable shocks, such as a global financial crisis or a pandemic. And at those times, forecasters have to think outside the models, translated to, we just panic and cut rates. That's all we know how to do, and that's what we're going to do again. But he goes on to say, our forecasters do this work on the biggest stage and with the high stakes, knowing the economy very often surprises us. So what he's trying to set up here is, look, we followed the data, we drove rates up, we're bringing inflation down, and you kind of just get the notion here that he's telling us, look, our mathematical models aren't perfect. Things change and surprise us. And he's setting up the fact that he's going to have to cut rates. He already knows it. And I want you to understand that this is critical because things with the banks, as you're about to see with Morgan Stanley's statement, are far worse than we know. Now, Powell goes on to say that the job takes large doses of courage and humility, but don't worry, when they hit their target, they're going to be the first to celebrate. But let's get to the banks now, because this is where there's serious problems that are brewing even bigger than the ones we've talked about already on this show. As the Fed says, tight credit standards and weak demand persist at the U.S. banks. And the reason we really want to know what's going on with lending standards is because it's everything to do with our monetary system. We talk about the inverted yield curves. We talk about the inverted money curves. You know, you hear from the mortgage bankers that rates aren't coming down that much. They're starting to, but they won't that much. It has nothing to do with all these mathematical models the Fed has. It has to do with one simple key issue. When you have a debt-based economy, you need the creation of money. It can only be created by the commercial banks when they originate originate new loans. And so when banks tighten lending standards, which we all know how this works, you go to the bank and they tell you, no, we're not going to lend to you. And because that makes it difficult to lend, it constricts the creation of new money. When you have a massively inflated bubble, it needs a lot of money to continue to support it. If it doesn't have enough, at some point, the bubble gets burst. And that's why all this stuff that matters comes down to only what the banks are doing. The proportion of U.S. banks tightening standards on commercial industrial loans for medium and large businesses fell to 33.9% from 50.8% in the second quarter. This according to the Fed survey of lending officers called the Senior Loan Officer Opinion Survey. Some 62.7% banks are keeping lending conditions basically unchanged, meaning that lending conditions still remain tight, and that has everything to do with how interest rates work. Because what I want you to understand is when money is being created and the economy is booming, interest rates go up. That's how it works, because people not only can afford them, but it helps absorb some of that money. Now, when credit is tight and there's not enough money being created to support the giant asset bubble or credit bubble inflated by central bankers, rates have to fall because there's one critical point that needs to happen. People need to borrow more money to create new money. You don't create new money, the whole system comes crashing down. That's why rates fall each and every time. As this chart here, you can see the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. This against the 10-year treasury yield. And what do we see on net when banks are tightening? That's any time it's over the horizontal black line. On the way up means more banks are tightening. On the way down, it means fewer banks are tightening. Nevertheless, you see in red, rates come down. You see it here in the dot-com bubble, the global financial crisis, the pandemic, and now is the first time where we see market participants bucking the trend, thinking that rates must go up, and all this is setting up for is a massive crash in interest rates. Of course, we know the Fed is going to follow the bond market down. That's kind of why Powell is nervous here. He's seen the 2-year treasury yield decline. He's seen yields decline. Despite his bullish nature on it, he knows the economy is slowing, and the bond market is telling him he's got it wrong. They show improvement from the second quarter, but it's true that the numbers are still pretty dire. The net share of banks tightening standards, whether for business loans, consumer loans, or commercial real estate, those numbers are still very elevated, even if they might be a touch lower than the second quarter, suggesting they're still constricting the creation of credit. That is all that matters at this point. Once the money in the system dries up enough, you see a surge in delinquencies, leading to defaults, and then outright failures like WeWork. You'll see it across the board. This is why China, no matter what it tries to do, it can't prop up those property developers. The Fed included some special questions in the survey on the likelihood of banks approving credit card and auto loan applications by borrower FICO score. They found a significant net share of banks were less likely to approve both type of loan applications from borrowers with FICO less than 620, and that's a pretty big chunk of the U.S. consumer that may have less credit available to them next year. More importantly, less money being created in the economy, less demand for goods and services. This is all a major issue that just says that the U.S. banking system is vulnerable, and wait till you see what Morgan Stanley has to say, because even the Fed admits it, that the U.S. banking system is still vulnerable. This according to the New York Fed blog, although they say it's less vulnerable than it was ahead of the 2008 crisis. Of course, we know what the Powell already just said. Their models, well, they don't actually take into account a whole lot of things, and they can't see things, but perhaps they know, and we know, that the small and mid-sized banks here in the U.S. are largely insolvent. We know the credit unions have lent out a bunch of money on used cars, and those things are coming back in a big way in the months to come. Is the banking system better? Not a chance. And because banks have been slower to pass along the Fed's interest rate hikes, depositors put their cash to work in other high-yield alternatives like money market mutual funds. Those losses in institution securities portfolios risk weakening capital levels. So here you can see the evidence. The banks need to create new money. They need to originate new loans. They're seeing money flow out. They're not lending as much. It's a problem because there's no safety net for these banks at all. And in March 2023, banking crisis highlighted the vulnerability of the banking sector that we now seem to think is less vulnerable than it was during the financial crisis to a sudden rise in interest rates. Specifically, banks' ability to limit the pass-through of rate hiking cycles and deposit rates allows them to benefit from higher rates, but only gradually because the Fed raised rates too quickly. And now we're talking about the next big problem the banks face, as Morgan Stanley's nailed this one on the head. It's not just a commercial real estate market that's going to be a huge problem for these small and mid-sized regional banks. It's now the changing landscape of what's going to come to these commercial properties, as you're about to see. As hot desking is the next threat to office market, this according to Morgan Stanley, is widespread adoption seen hitting demand for floor space as companies look to cut their expenses in a big way. This happens as we get in recessions and money tightens up. We know that a lot of these properties, they need big rent and they need it now. And of course, this is a problem. So as companies look to cut space, this is what they're about to do. And this will send shivers through the banks who are in big problems because they're the ones holding the notes on these buildings. And Wall Street, well, they got a bunch of money in commercial real estate. Along with work from home, hot desking is one of the most structurally damaging headwinds facing the office market. Were it to be adopted more broadly, the reduction in floor space requirements would likely have a considerable impact on occupational demand. The property sector has suffered this year as interest rates have soared, and while commercial and office real estate firms have been grappling with a shift toward hybrid working models, and what this indicates is that hot desking is the use of flexible work areas that aren't assigned to specific employees. It appears to be most prevalent in the UK, according to a recent survey. Among UK respondents, 30% say it's been introduced since the coronavirus pandemic, versus about 20% in Germany and France, and only 13% in the US. You imagine this starts to take fire here in the US. You see hot desking becoming a way of life. That means less floor space. That means these small and mid-sized regional banks, they are not just insolvent now, but they're going to go out of business completely, even at 0% interest rates. And this is what I want you to understand. The Fed can't save what's coming. Powell knows it. You can see it. And so now we can see Morgan Stanley's dire warning. Well, it says there's shockwaves coming for the banks and Wall Street. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.